Hi everyone. Welcome to the Money Knowledge channel. In this video, we will talk about Canada's Registered Retirement Savings Plan RRSP. I will provide a detailed review of what RRSP is, how it works, and the different nuances about the plan, so you can find out if RRSP is the right investment vehicle for you, and how you can take advantage of it. RRSP, Registered Retirement Savings Plan, is a Canadian government-approved account that allows Canadians to plan for retirement. It was introduced back in 1957 to provide a way for people to save and invest their money in a tax-efficient manner. Many people are confused, but RRSP is not a type of investment, but rather an investment vehicle. You can use your RRSP to hold different types of investment like GIC, mutual funds, or stocks, etc. Your contributions to your RRSP account are tax-deductible from your net income on your current year tax return, so you can enjoy paying less income tax. And tax is also deferred on any investment income that is earned on those funds, while they are within the RRSP, so you can enjoy what people called tax-deferred investment growth. Funds taken out of the registered plan are taxed upon withdrawal. Since usually the withdrawal is after retirement, your tax rate at that time is typically lower. RRSPs are popular because they are flexible compared to other retirement savings vehicles. Contributions to an RRSP are left entirely to you. You can choose to make no contribution, a small contribution, or a large contribution within limits in a year. And you can alter the choice of contribution from year to year as you desire. So who is eligible for RRSP? All Canadian taxpayers with eligible income can invest in their RRSPs. Interestingly, there is no minimum age required by the regulations to open an RRSP. However, some financial institutions may require their customers to be the age of majority. You can set up and contribute to an RRSP up to the end of the year you turn 71, as long as you are a Canadian resident, have earned income, and file a tax return. So what are the common qualified investments that you can put into your RRSP? The more common qualified investments for an RRSP are Guaranteed Investment Certificates, GIC, issued by a Canadian trust company. Money deposits in a Canadian bank, trust company, or credit union. Mutual funds, government and corporate saving bonds. Stocks listed on a designated stock exchange, or exchange-traded funds, ETF. I want to call out for more advanced investors that covered call options as well as put options are also allowed to be held in your RRSP account. You should note that there are some common non-qualified investments such as share of many private companies, future contracts, real estate, and personal property such as antiques and gems. Let's talk about the contribution room limit. As mentioned briefly before, contributions to an RRSP are deductible for income tax purposes. The amount that you may contribute in any given year is called your contribution room. And your contribution room in each year depends on a couple of factors. The first is your income history. You can contribute up to 18% of the earned income up to a cap. In 2022, that cap is $29,210. If your work has a company-sponsored pension plan, then your room would be reduced to reflect the contributions made to the pension plan. If you have not maxed out contributions in previous years, you are allowed to catch up. In other words, you can carry forward unused contribution room from the previous years. This carry forward is particularly important for young people because it allows you to focus on other financial priorities without reducing your ability to invest in RRSPs later on. On the slide, I am showing the maximum RRSP contribution limits for recent years. One important thing I should mention about RRSP contribution is that there is a penalty for over-contribution. Any amount up to $2,000 over your annual contribution limit is subject to a penalty tax of 1% per month. Okay. Let's switch to another interesting topic. There is a special feature of RRSP called Spousal RRSPs that not many people know. With spousal RRSP accounts, you may choose to contribute to an RRSP in your spouse or common law partner's name, while claiming the contribution as a deduction on your own tax return. Contributions to a spousal RRSP are based on your contribution room, not your partner's. Couples can split their income at retirement with spousal RRSPs. They can minimize their income tax liability when money is withdrawn from the plans. Yes, a spousal RRSP can be a useful income splitting tool. It allows the spouse or common law partner who is currently in the higher tax bracket to claim the deduction while allocating the retirement income to the partner, which could reduce taxes as the funds are withdrawn after retirement. Here is how a strategy with spousal RRSP would work. The idea is to build two pools of retirement savings that will generate two similar income streams during retirement. Under Canada's progressive tax system, you, the taxpayer, and your spouse would likely pay less tax on two similar amounts of retirement incomes than if all the retirement income were taxed from the higher income earner. So remember, the goal of income splitting is to build two savings, in other words, two retirement income streams, that are in similar size. You should note that the wider the gap between the two pools of savings, the lower the tax savings would be. Now let's talk about withdrawal from a RRSP plan. Your RRSP investments may be withdrawn at any time as long as they are not in a lock-in plan, but the withdrawal will be subject to a withholding tax, and the amount also needs to be included as income when filing your taxes. Based on the amount withdrawn, the tax rate is different. You can see the details on the slide. Your financial institution is required to withhold this tax on behalf of the government. So while you can take out money from your RRSP at any time, you should understand the implications, and they are: 1. You will pay a withholding tax. 2. You will pay income tax for the withdrawal. 3. You will lose out on tax-deferred compounding of the fund. And 4. You will lose your contribution room for the amount. There are situations in which tax-deferred withdrawals can be made from your RRSP. For instance, if the funds are used for the purchase of a home for the first time through the Home Buyers Plan, or for funding education through the Lifelong Learning Plan. Under the Home Buyers Plan, HBP, you can withdraw up to $35,000 of your RRSP savings, or $70,000 for a couple, to help finance your down payment on a home. To qualify, the RRSP funds you are using must be on deposit for at least 90 days. You must also provide a signed agreement to buy or build a qualifying home. The best part of the Home Buyers Plan is the withdrawal is not taxable as long as you repay it within a 15-year period. The payback amount is at least 1/15 a year of the amount you withdrew from your RRSP. If you are thinking of buying your first home, you should also check out my video about the new tax-free First Home Savings Account, FHSA. FHSA was proposed in 2022 and may be a better solution for you instead of the Home Buyers Plan under RRSP. Okay, now let's talk about what happens to your RRSP when you are reaching retirement, or sometimes we call that the RRSP matures. An RRSP matures when it begins to provide you with retirement income. Currently in 2022, you must mature your RRSP by the end of the year you turn age 71. And you can choose one of these three options. First, you can withdraw all your RRSP funds in cash or in kind. The big problem with this approach is that the value of your RRSP funds will need to be reported as your taxable income in that year. So while this option is the simplest, this choice is usually the least tax-efficient maturity option. The second option is, in the year you turn 71 or earlier, you can use your RRSPs to purchase a financial product called an annuity. An annuity is a contract that binds a life insurance company to deliver an ongoing income for your entire life, or for a specified period of time in return for a lump sum deposit. If you purchase a life annuity, you will not have to make ongoing investment decisions, and it will provide a guaranteed income for as long as you live. Your future income is guaranteed by the annuity provider. Generally speaking, the decision to annuitize is a permanent decision which cannot be reversed and must be considered carefully. The third option, and it is also the most common option, is to transfer your RRSP into something called Registered Retirement Income Fund, RRIF. There will not be any tax implications on the transfer from RRSP to RRIF. With a RRIF, tax implications arise only on the amounts withdrawn from the plan. So now you have the details about RRSP. Are you convinced? Are you ready to open an RRSP account? Many employers have set up what we call a Group RRSP for their employees. You would have the option to automatically deduct your RRSP contribution from each paycheck. Also very important for people who have Group RRSP at work. Many employers offer a matching program that would match a percentage of your contributions, usually from 1 to 5% of salary. So check with your benefit package or with your HR department. If your employer does this, I highly encourage you to contribute enough to max out what your employer will pay. That is free money that you don't want to leave on the table. As I mentioned earlier, there is no minimum age required to open an RRSP. While when to open an RRSP can differ from person to person. My suggestion is that if you think RRSP is a suitable tool for you, then the earlier the better. It is never too early to start investing for retirement. So there you have it, now you have a good understanding of registered retirement savings plan. What do you think about it? Do you think it could help you? Tell me in the comments below, I would love to hear about your thoughts. In my upcoming videos, I will answer some common questions related to RRSP. Such as how much should you contribute? What is the best RRSP contribution strategy? Should you borrow a loan for RRSP contributions? Should you contribute to RRSP or should you pay down your mortgage? Should you put money in RRSP or should you use another popular saving tool TFSA instead? To stay up to date with my latest videos and cool money management tips, make sure to subscribe to this YouTube channel by clicking the subscribe button if you haven't already done so. Until next time, stay safe, happy money management. Thank you.